The only game left in town is U.S. stock market. By the end of the year, everything will be down, including inflation down, crude oil down. Everything will be down following Bitcoin, following precious metals, bond yields lower. The key question is what's going to be the end game. To me, the end game is this pump, then dump pattern. Lead the leader. Number one, cryptos and Bitcoin. I just enjoy all the people keep trying to buy the dip. I'm like, what are you missing about this asset class? It is now the complete dud in the space. You sell the duds, look to sell duds. Now that is almost a guaranteed recession. People just pull back. Everybody knows we're overdue for it. So
Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence, is back. Welcome back, Mike. Good to see you. A lot to discuss today.
Oh, yeah, David. Well, thanks for having me back. You're one of my favorite persons to talk to, and I do appreciate a lot of your interviews. They really are very educational.
Thank you very much. It's high praise coming from you, Mike, and you're one of the guests that make our program successful. So let's start by talking about why precious metals have been down all year and focus on the macro behind the picture here. It's not just gold, it's palladium, it's platinum, and I'll pull up a chart here just to leave on the screen for the audience to look at while we discuss this. Gold is at $4,000 right now, considerably down considerably from 5,000 just a couple months ago, and 5,500 from its highs. And it's not just gold, the gold price, it's the sentiment of gold. If you take a look at the COMEX open interest, for example, that's actually at a negative position right now as we speak. And if you take a look at other indicators like the bullish index for gold miners, that's at multi-year lows as well. What happened?
Yeah, well, there you go. Pump, then dump is the theme so far this year. The significance for my outlook is I think it's just getting started. So every single precious metal, gold, silver, platinum, palladium, pumped. Most of them pumped on the back of gold. Silver caught up. Silver was up 60% and it dumped. It's classic peak stuff. Some of us have been bullish precious metals, most notably gold, for decades. Looked at that as sometimes a bell rings and gives you a chance to sell. And for now, we've had a decent backup. So let's look forward. 4,000 gold's decent support. I think ultimately the bottom doesn't really come into 3,500. I think it's stuck in a range for years. If history is a guide, the key theme is these are non-income producing assets, stores of value, speculative. Obviously, they get way too excessively speculative. And then there's just a much better game in town. First of all, I look at what's your alternative to things like gold? Well, that U.S. long bond at 5%, I think, is way too much opportunity cost. And there's only one game left in town. It's just the unprecedented earnings in the stock market and that rapidly advancing bull market. So to me, that's sucking everything, most notably from the metals, from commodities, from cryptos. And the key question is what's going to be the end game? To me, the end game is this pump, then dump pattern, which started in Bitcoin and natural gas and silver and corn, is going to trickle down to everything, including crude oil and the stock market. And the stock market might lead everything.
Who's been doing this pumping and dumping? I mean, we don't know for sure.
Well, there's nothing like speculators jumping on board. I just love that when you get that positive gamma kicking in, you ride it. And then those of us who are long-term try to strategist investors, you say thank you and you selling when they're yelling. So mostly good speculation. You mentioned some of the speculation declining in gold. And I haven't looked at that so much, but I'll look at gold at 4,000. Now it's finally at a decent level. Macro big picture, I think it's stuck in a trading range like crude oil has been for the last 20 years. That's just usually how it works. But the key theme for everything is right now, as we speak, 180-day volatility in silver is the highest since 1980. That's almost 50 years versus the S&P 500. 180-day volatility on gold is the highest versus the S&P 500 in almost 20 years, 2007. 180-day volatility in the Bloomberg All Metals Index is 2 to 3 times the S&P 500. See the problem there? That's a sell signal that tells you speculation is kicked in the metals. Now we're just reverting, but it's also showing you that how low volatility is in the stock market. That's my key theme this year. So far, I've been wrong. I think it's going to play out that volatility that we're seeing, that massive volatility in gold and metals and crude oil, will pick up to the stock market. It always has. and we're going to see a normal backward and back down in the stock market this year, basically a down year in beta. We're way overdue for it. It's a midterm election year. The only two down years, the S&P 500 since 2009 have been 2018, 2022, midterm election years. And the cryptocurrency market is guiding us that way. So to me, this is going to be that kind of year. It's great for traders and probably not so good for buy and hold investors. And metals are good indication that they're all down. So I'll just give you a little indication. To me, copper's next on that list to potentially pumped to potentially follow the dump. And the key theme for copper that's just to stay elevated is stock market has to go up, and it might be indicating that it's just going to go down in the year.
But copper, okay, I'll come back to this chart in just a bit. I've left that there for a reason. But copper has been diverging from gold. So if you take a look at copper right now, and that's not actually a good ticker. If you take a look at copper and how gold have performed relative to each other, they have followed each other quite closely. Like the correlation long term is like very close to 1, first of all. But especially in the last year or so, Mike, they've been trending together, ups and downs. And ever since ever since May, they've been diverging. Why is that?
First of all, gold got too expensive, but copper, to me, I view it as almost completely dependent on that rising stock market. So I like to use the per pound price of copper. You just take that per pound price, divide by the S&P 500. S&P 500, just take 3 zeros off. It's been the same trade really for 10 years. And S&P 500 starts taking off in 2023. Yeah. And copper's just lagging behind. Why is it lagging behind? Well, okay, so AI is kicking into the S&P 500. We get that. It's all technically get that, which should be demand for copper. But if you overlay copper with what's happening in iron ore or what happened in crude oil, they're lagging, and in bond yields in China. Those are my key indications. So my copper team based in London, Grant Sporia leads it, says copper's pretty well balanced, parity still somewhat of a deficit, but your bottom line is its performance is just absolutely been poor versus the stock market. And I have to point out, if you're an actual investor in underlying copper or rolling futures, actually holding the metal, you are trading at 2 to 3 times the volatility of the S&P 500, and your performance has basically lagged completely for years. That's just a poor performing asset. I get it, electrification, decarbonization, everything, this little pump in energy got it, but it's telling you this is a waning asset. This is a weakening metal, and all the other metals are starting to trickle down. Iron ore is even down on the year now in China. It was up. It's telling you, to me, if you're long copper, you need that stock market to go down or go up. And the stock market drops, which I think it will, now copper's going to probably drop at 2 to 3 times the volatility based on what is normally works, how it normally works out.
If you're watching markets move in real time and thinking about how to act on these movements, well, today's sponsor, Plus 500, is built exactly for you. It's a futures trading platform regulated by the CFTC and NFA in the US and listed on the London Stock Exchange. You can trade across crypto, forex, indices, energy, metals, and agriculture, all from one interface. What stands out is speed and control. You get live price feeds, built-in technical indicators, and proper risk tools like stop loss and take profit, so you're not flying blind when positions move fast. And if you're not ready to put money on the line yet, there's a free demo account where you can test strategies in real market conditions without any risk. Scan the QR code on the screen here or use the link in the description down below, and you can get $30 off when depositing $300. Terms and conditions apply. You said earlier, one of your comments, stock market leads. So what is the stock market telling you right now?
Well, it looks to me like we're way overdue for just some normalization, like I mentioned earlier. The key indications I like to point out is I get a sense that day to June 5th, and the stock market will go down in history. That was kind of a peak where it dropped 2 to 3% on the stronger than expected unemployment number. We'll go down in history similar to October 10th last year in cryptos that put in the peak. They've been in a bear market since. Continue to go down. Great leading indicator there. The last to usually go down is U.S. stock market. I think it's just a matter of time. So I think what we have so far this year is initially at the beginning of the year, we had a bit of a red candle on the year and then it went up to green. I think by the end of the year, it's going to just be a big red candle in the stock market, following what's guiding us in cryptos, following the lessons of volatility and massive speculation with all this, all these IPOs and things. And if I'm wrong on that, then the key metal that should stay stable is copper. But the key thing right now is just really, its only game left in town. And I look at all my other analysis. I look at copper. Yeah, it'll be fine if the stocks go up. I look at metals. Oh, they'll be fine if the stock market goes up. I could even commodities. They'll be fine if stocks go up. We've just reached that end game. And here's a key theme: is also now we have the latest inflation number 4.2%. Now that's probably a peak. That's CPI because of energy, but we've reached that end game. Well, when you get to 2.5 times GDP, maybe 2.4, it's come down a little bit. That's U.S. stock market capitalization. That is the 10 on a 1 to 10 scale for increase in inflation when it goes up and deflation when it goes down. It is the 10 on a 100-year basis and based on history and other examples. Japan in 1989, 1990 when it peaked. U.S. in 1929. It is a 10, but it's what we've reached now is Mr. Trump keeps trying to pump up the stock market, and he should be realizing and looking over his shoulder. I'm like, yeah, if you do that, it's the number one issue in elections is affordability and inflation. You keep doing that, you keep inflation, you are not going to get the Republicans get hammered in the midterms, and the next president, if this keeps up, is much more likely to be a Democrat. See the lose here? We've reached the end game. And if stock market goes down, it's the number one reason they've created a recession because it's 2.5 times GDP. So that's all my signals. That's part of the reason I think gold figured out last year. It warned us. Cryptocurrencies peaked, warned us. All this volatility we're seeing in crude oil and gold is just a warning to just get out.
It's extraordinary because it seems like tech stocks are the safe haven right now, with volatility happening all around the world, the Middle East experiencing a war, and you're talking about a potential recession. Gold is not the place to be right now. It's tracking something else, and that's not volatility.
Well, it's tracking what it did last year. It warned us. I mean, I was lucky enough to be on top of that trade. I made the tilt in late 2024 to get out of cryptos, focus on gold. And I just never expected to be the best year since 1979. But now it has. It's warned us something. It front ran the war. Now we have this war. But the key theme is the bottom line, the 10 for everything on a global scale for all risk assets, for all assets, is the stock market in the U.S. has to keep going up. We've just never had that kind of a burden, which means the risk arbitrage goes down. So to me, that's where it is. Gold warned us. And that's also the bottom line with almost all of the risk assets. Everything's basically a dud now. Most notably, cryptos are duds. Metals are duds compared to the increasing stud as the stock market. And that stud, when it rolls over, which I think will be this year, I don't know when, tells you that's just finally we're near that end game. We're way overdue for some post-inflation deflation, which afflicted Japan for 30 years and has basically been affecting China for most of the last 5 to 6 years.
So you're still sticking to your deflation thesis?
Oh, sure. Well, I am. Let's see if I get stopped out on that. Let's see what's happened. Look at precious metals reversed, cryptos reversed, volatility in the stock market still way low. The bottom line for all deflation is just a reversal in the stock market tilting back down in the air. Then that's your severe deflation kicking in. And the later the year it happens, David, the worse it's going to be. And I'm just sensing that this is, a selling when you're yelling market that I sensed in cryptos earlier last year and in metals this year. It's just trickling over the stocks.
Let's talk about inflation for just a minute. Yeah, 4.2% inflation. Most of that came from energy, to nobody's surprise. Yeah. If you take a look at core, however, that's actually not moved very much from the previous reading. And several items within the core index came down, notably medical services, used trucks, used cars. The things that did go up, for example, energy, gasoline. If you strip that out, which is what the Fed looks at, that actually isn't that significant. Maybe your thesis is still playing out. Of course, nobody predicted. Nobody saw the Iran war coming last year. So if you had made a deflation thesis last year, probably got sidetracked by this war. But ultimately, the core thesis is still probably intact. And yeah, go ahead.
I think so, but it never can and can't be easy. I'm making basically a call of a lifetime. This is normal reversion kicking in. But what's driving inflation right now? Most people claim it's energy. Yes, we've seen the pump up in gasoline from 280 to like 4 or 13 at the moment. It got to near 5. It's coming back. But the bottom line is, if you look at the Bloomberg Energy Spot Index, which includes gasoline and heating oil and diesel and Brent and WTI, the price it peaked at this year, David, was first traded in 2005. See, that's a 20-year range. We're near the upper end of the range. It's going to go back down. Just the way it works. So it's helping accelerate inflation, but the bottom line for all inflation is the U.S. stock market. Now, energy in the short term, that'll go back down. But the problem is we've reached that high price cure. So the key thing I like to point out about energy, even crude oil, right now on the screen front, crude oil is $90. That's WTI. I was first traded in 2007. Not a big deal. But in terms of inflation, what I'm hearing from my colleague Anna Wong is we're seeing a lot of curtailing of other discretionary spending because people are having to spend on energy and food and things. But this is not just crude oil and energy. I see pretty severe potential deflationary forces, normal cycles kicking in corn and soybeans and wheat, and most notably natural gas, U.S. natural gas, the number one measure of heat, electricity, and fertilizer. It was up 100%, that front future at the beginning of the year. Now it's down 16%. It's hovering around 3. Typically it goes down to 2. Yes, it goes up for summer, for winter, demand season. But that's the number one measure of heat, electricity, and fertilizer in this country, and it's starting to tilt lower. So I see dominoes for deflation accelerating, and the biggest one of them all is the stock market. So that 4.2% will probably be a peak. David, I remember it well. It was July of 2008. Inflation's CPI peaked at 5.6% with crude oil around 147. Now here at 4.2%, we're worried about crude oil, which peaked about 120 this year. The key thing I like to point out is since that bottom in crude oil in CPI in 2009 at minus 2%, we've bottomed around that level or 0 3 times. I think we're going to do it again. By this time next year, I fully expect CPI to be near 0 and maybe even negative if the stock market goes down, because it'll prove to me that's the number one theme for all inflation. And it's the only way I think you're going to get the Fed to ease is the stock market to go down. See that endgame? And Mr. Warsh is hopefully smart enough to figure that out because his legacy will depend on it.
Right now, the bond market is predicting actually hikes, not cuts. And
right.
And the long end of the curve has been following that projection upwards. The 10-year is now at 4.52%. And this presents a challenge, by the way, to other asset classes if the long end of the curve continues to go up. HSBC has already called this the danger zone. So how are bond yields going to react in the intermediate term before this deflation kicks in?
Well, I like the recent pivot from Mr. Trump to Warsh to do what you have to do. And now he pushed back later that the Fed should ease. The bottom line is Mr. Besant's probably leaning over to Mr. Trump saying, oh, by the way, Donald, you need lower yields. You need lower inflation. You need to let the Fed do what they need to do. And maybe hiking rates in the short term will get you those lower yields. Because what's happened. The first time since they started cutting rates in September of 2024, bond yields, I'm looking at the long bond. I use that because it's at 5%. It's at that key level, are up 100 basis points. The stock market's up like 35%. Energy prices up about 35%. But the 10 on a 1 to 10 scale on a historical basis for all inflation is the stock market now. And Mr. Trump, once he figures it out, might be able to say, hey, if it backs up a little bit, I'll get those lower yields. Maybe I'll help my Republicans in midterms. And maybe if I don't keep inflation bid up, maybe the next president will not be a Democrat, because the way we are right now, the way trends are going, the next president will be a Democrat. So I think he's going to care. I think all Republicans are going to care. But the bottom line is what happened is we've had the Fed cutting rates with the inflation well above their targets, and the stock market on the tear. History is going to look back and then say, yeah, that was dumb. You're not supposed to be adding fuel to the fire of inflation, and they have been. Now, Mr. Warsh has an epic opportunity to go down in history more like Alexander Hamilton versus Aaron Burr, or Paul Volcker versus, who was the other? Arthur Burns, because this is his opportunity. His term will move beyond Mr. Trump's. And the proper thing for the Fed to do is it's kind of hard to cut rates, but you're probably supposed to be hiking rates in this environment. Now, ECB just did today. The rest of the world's hiking rates. That's a major pressure factor on gold. The bottom line is we are going to get post-inflation deflation at some point. The problem is going to be from a much higher plateau because the Fed started cutting too much too early and help fuel that inflation.
This is what Trump said at a press conference at the Oval Office. The numbers were great. You know what I really love? I love the inflation. You know why? Because as soon as this war is over, when the war is over, it's coming down. It's going to come down like a rock. That's kind of your thesis as well. But he loves the inflation, Mike.
Yeah, well, your average, but that's the key thing that's happening. 55% of the people in this country are wage earners. That's kind of the bulk of the bell curve that voted for him, not the rich people. Also, the top 20% who are benefiting from the stock market going up. They're now separating that K-shaped economy. And that's what's happened. You see it in the polls. He's just getting hammered in the polls every day. The stock market market goes up, inflation goes up. Obviously, the war is related, but he also got himself into a big quagmire. The war that he won, everybody else is losing because we're paying more at the pump and more for energy prices, and consumer sentiment is getting hammered. What's it going to take, first of all, to get from midterms? This is the first trade I'm looking at, to get to the midterms for him to help alleviate that. Now, I fully expect he will. I fully expect that December crude oil contract, which is the top in open interest, will be front month around midterms. Is around $80 a barrel right now, to be closer to 50. He needs that to happen. He can make that happen. Now, what happens in the Gulf is a different story. How he figures that out, we'll see. But he will. Also, we're seeing the classic example of the invisible hand, an invention when there's necessity. Oil's coming out of the Gulf through pipelines and through other measures, and it's really accelerating this surplus of supply from the U.S. and Canada. And one key theme I really enjoyed is I've seen on the Bloomberg energy chats is people are shocked about what happened in China. And what's happening in China has been steady. The number one importer of crude oil forever, importing between 11, 12 million barrels between 4 or 5 years. But what they did last year is their demand's actually declining. They'd use almost all those imports to really pump up their strategic petroleum reserve. Some estimates are near 1.8 billion barrels. That's 5 times the U.S. And now what they're doing, the Chinese are always do. They're the best commodity traders on the planet. They bought, allocated to crude oil was around $60 a barrel. And it got to near 100, started selling. Just they're a great governor and great indication what to happen in what happens in commodities, and they buy low and sell high. But the bottom line, what's really shifted is the U.S. doesn't need an SPR anymore. It was created in 1974 by President Ford to cover 90 days of net imports. With Canada, we are approaching 9 million barrels a day of supply surplus, with if you include crude oil, liquid fuel, biofuels, and mostly liquid fuels. It's just the world's changed.
One thing that has changed for me that has stood out is that I'm no longer talking about the markets as a whole. I'm not saying, hey, everything's gone up or everything's gone down, which was the case in 2022. What do we do? Where do we hide? Or in the case of 2024, 2025, it was throw your money on the dartboard and you'll make money. This is no longer the case. And that's the biggest shift for me this year as somebody covering the markets. You're no longer in an environment where gold's at all-time highs, Bitcoin's at all-time highs, stock market's at all-time highs, and it's really a picking the assets game. In this kind of environment, what is the criteria that investors need to have on his or her dashboard in order to pick the winners?
So the winners right now, the only game left in town is U.S. stock market. And my predictions by the end of the year, everything will be down following Bitcoin, following precious metals, bond yields lower. And the bottom line is once that stock market, if it just gives away more of its gains, goes up. U.S. stock market was up about 12% in the year. Now it's only 7%. I mean, it's waning. I think by the end of the year, everything will be down, including inflation down, crude oil down potentially on the year. And the bottom line is we got to, for that to be wrong, stocks have to go up, but everything's starting to trickle that way. That's why I trickle that way. That's why I point out was heed the leader. Number one, cryptos and Bitcoin. I just enjoy all the people keep trying to buy the dip. I'm like, what are you missing about this asset class? It is now the complete dud in the space. You sell the duds. Look to sell duds in a market that's shifted to the dud, and you buy the studs or buying the stock market. But when the only final dud left, look at precious metals. They've turned into a dud. Cryptos have turned into a dud. Corn has turned into dud, potentially agriculture. All you need is a normal winter, and you're going to see pressure on that. A normal summer, normal growing season. And to me, that bottom line is, and they're all buying the studs. Now, once the stud turns, which is the final game left in town, that's your post-inflation deflation. And best, I think my focus remains, U.S. Treasuries might grab alpha this year. Haven't been right yet, but that 5% long bond, I think, is going to we're going to look back and say, that was your last chance. Okay,
Treasuries are your pick. The Bitcoin price I have on my screen. What do you mean it's not a buying opportunity? It's down 50%, Mike.
Exactly. I love hearing that. The bottom line is, yes, it should be bouncing. Initially bounced from 60 back to 83, the 200-day moving average. The bottom line is it is now the stud in the space. There was one in 2009, and now there's millions. It's a space with unlimited supply. When people say Bitcoin only has 21 million, it has limited supply, I say, well, what's Bitcoin Cash? What's Bitcoin Gold? What's Bitcoin Satoshi Vision? This is a space that's in the middle of a purge. And then there's so many of them that are just way overdue to purge. Dogecoin is a joke. It's still worth $13 billion. You have to wipe that out to take that to zero. Mr. Saylor was a great indication to buy around 2010, but when he doubled down after a 10x, that was another indication to sell. I think we're going to get MicroStrategy and things like those stopped out. And then you'll put in an enduring bottom. So I think the next key support's around 50,000. I doubt it stays above 80. I think it's going to 10. That's Bitcoin. Bottom line for Bitcoin to stay stable, just to not go down, is the stock market has to go up. And we saw those few indications a couple of weeks ago in May when Bitcoin started to go down, the stocks were still going up. That was your sell signal. It's ticking in. It's going to hit supports. It's going to bounce. It's the way markets always work. But focus on the macro. This space is the dud. It was the stud. It shifted to dud. That should last for a while. And the one thing I like to end with, the most enduring pattern and trend in all cryptos is tether flipping in everything. Now, this last weekend, I think it was Saturday, June 6th, tether flipped in Ethereum for a little bit to become number 2. Now it's back as we speak on June 11th. It's number 3. It's a matter of time. It flippins Ethereum. And to me, it's a matter, I think it'll be this year. I think it's a matter of time and that trend continues and it flippins Bitcoin to become the number 1 crypto. And I point that out because that's the significance of this space. We're finding out it's a great way for the whole world to get access to the US dollar via their phones. You don't need to speculate in all these other cryptos to get out of their system. And the dollar is becoming dominant. Tokenization is becoming dominant. Is when you get real assets on a chain, on blockchain, next to other assets that track nothing. What are you going to buy and what are you going to sell? You sell. You're gonna just be looking to short the stuff that's speculative, like Dogecoin that tracks nothing. You're gonna be looking to buy or at least arb the stuff that tracks something, has an underlying something that tracks. For instance, right now the key things are U.S. Treasuries and stablecoins.
Well, how did sentiment in this sector get so bad? Was capital sucked out into and placed into the AI sector? We had Charles Hoskinson, by the way, just last week, admitting on a video that Cardano, the project he started, is dead. Remarkable words. There's a big feud over Twitter over this. But when you have a founder of a major project making these kinds of remarks, it's echoing the overall sentiment of the entire sector, which is that crypto is dead. And Anthony Pompliano, I interviewed him in Miami when I was at the Miami Consensus Conference. One of the most outspoken proponents of the crypto sector for years and years and years, and he said most of crypto is dead.
So it's good to hear that. Oh, go ahead. Sorry.
That was it. My question is, how did this happen?
I've heard some of your interviews. I appreciate that. DI deliberately avoided the consensus conference. I go to a lot of conferences because I knew what it's going to say. They're all going to be talking about bullish things and the space is dead. I will go back when I think it's time to get back in, because what happens in conferences, a lot of times you get a lot of people who say things that everybody else wants to hear. I've so heard that I was at a conference late last year, and it was a wealth conference in Naples, Florida, and I deliberately told everybody Bitcoin's going down. I got booed. I really appreciate the boo, because that's what they did not want to hear. And that's why it's important to say that. But the bottom line is price drives everything. Price has peaked. And I like to put in the macro that we had the best back test in history. We had a good reason. This was a new, unique type of money. Massive speculation. ETFs were launched, and it took it away from the insiders that people got in early. I've got in part of that. To the mainstream, and then he had Mr. Trump jump on board, and people like his son and sons, toting up coins. People might make that illegal in the future. That's a classic peak. Now in the purge, the questions, where's the bottom? And I like to say, okay, if you expect any type of stabilization, number one, the stock market has to go up. That's already starting to tell you. So to me, this purge is going to continue. You're supposed to send every rally in these duds until we purge all these excesses. And the bottom line is a commodity person. I like to use the analogy I was using last night is cryptos are basically a bunch of pigeons versus doves in precious metals. Just the doves flew too high. There's just so many pigeons. We got to purge them. Like you mentioned, Cardano. There's just so many of them. We purge those, get those back to reasonable prices, and then we might have a decent rally to bounce. And just key thing, I love the quote from Jim Grant is bubbles precede use cases. And the use case right now is tokenization. The dollar's winning. You don't need XRP when you can just use a dollar on a token.
So you said that the world is changing and wanted to hear the world is changing, or the world has changed, were your words. The world has changed. I wonder if this change that you're referencing is permanent. And the follow-up question to that is, what does the end game that you're referencing look like in relation to the world changing?
Well, I'll start with the end game. To me, it starts with what you saw in cryptos. That purge is crippling and will trickling down to metals and commodities and the stock market. And we'll have a down year this year is my prediction this year, and then we'll move from there. But to me, this is part of a post-inflation deflation that books like The Price of Time by Edward Chancellor say always happens. It's always a matter of time. And we should have a purge reciprocal to the surge. Hasn't started in the stock market yet. That's wonderful, but there's been great indications and great opportunities. 5% on the long bond. You can lock in that for, who knows how long. And then, of course, if yields drop, you make a lot of money and very low return, very low risk. But to me, this is just getting started. To be wrong, the stocks have to go up. To be right, it starts, in the baseball, they always start to say it starts with the walk. It starts with the stock market turning red in the air. My point is if it starts turning red as we move on to the second half, it's not going to stop. As much as Mr. Trump tries it, but here's the significance of it. Why it's so important, Dave, is we've reached that point, and I love writing about it a year ago when Mr. Trump got elected. Well, he's got the timing of Herbert Hoover, who was elected in 1928. I'm sorry, but we're just that expensive in terms of all risk assets, and he keeps trying to pump them higher, which makes inflation go higher, which makes his voters get upset. It's the lose-lose end game. Maybe we'll get lucky. Maybe people call, last year they called me, I enjoyed that nickname I learned in cryptos when I was bearish. Nickname was Mick Retard. I own that nickname. I love it. And maybe by the end of this year,
that's mean.
Oh, come on. Come on. Social media, it's part of I love the banter. It's just some of us, you're never right when people call you McGenius. In fact, if you think people say you're right about something, that's usually when it's time to get stopped out. But I love that. And if I'm still Mick Retard in the stock market by the end of this year, then the whole base case changes a little bit. But right now, there's only one stud left in the whole world right now. It's the U.S. stock market, and all the other studs, most of them have been going by the wayside. And when that goes, we're just going to get a normal reversion in CPI towards zero. Always has happened. It's happened 3 times. Normal reversion in crude oil back down, and you're back towards 40. I mean, that's what it's done 3 times in the last 20 years after spiking up high. Some other markets, copper probably easily towards $4 a pound. If this normal happens, this is the normal reversion. Silver below 50, normal reversion. I mean, it was just still well above where it was a year or 2 ago. But all that stuff, for that stuff not to happen, that S&P 500 up 7% in the year better be up 15% by the end of the year. If it's up below 7 or ticking down, it's just the normal version kicks in as indicated by Bitcoin.
Yeah, and by the way, I think the S&P might soon include SpaceX, and we'll see how that performs, and we'll see how that moves the market, because at that kind of valuation, it'll certainly move the entire market one way or the other. Now, finally, Mike, speaking of comments, I don't think my audience has been mean to you, but I have seen, the perma bear is back. I mean, you're not a perma anything. You're just looking at what the data is telling you. But when you see comments like that, and how do you react? Do you look at that as a sentiment gauge?
So in the stock market, it is completely accurate. You got to own your mistakes. I've been wrong in the stock market for way too long, but I found major alternatives. First of all, in cryptos, Bitcoin, most notably in 2019, when it was around 3,000 to 5,000. I mean, that was a classic buy signal. I enjoyed putting out and then pointing out when it was at 10,000, 2020, it was going to add a 0. And then gold, and I've always been bullish. Gold is a great alpha source versus the stock market. That's worked since 1997. It's provided lower volatility and better returns since the stock market. Now, it fell off that horse recently. But now, admittedly, I view, since those trades I think are over, there's only one game left, and that's the treasury market when the stock market goes down. When means I think it's going to be this year, but that's an accurate comment. I own it. They're right, but I like to point out I found the alternatives. Now, as a commodity strategist, I used to point out is if you're bullish all commodities at this stage now, any broad commodities, you basically have to expect the stock market to go up, because the number one thing to remember in commodities is elasticity. Prices go down because they went up, because the ability of humans to create more with less. And when metals roll over like they're the least elastic commodity, you got to be worried, and I'm worried.
Okay. Final question. What kind of a correction are we talking about? 20%, 15%? I mean, nobody knows for sure, but the scale would match your thesis. In recessions, typically it's 50% for the S&P 500. For a bear market is defined by 20% from its peak. Are we going to be in bear market territory at least?
There's only two examples of history in terms of stock market cap to GDP, and that's 1929 in the US, that peak, and 1989 in Japan. Now, I was part of that one in 1989 in Japan. I started in the business in 1988 covering Japanese clients from the US. So the bottom line is, let's look at the facts. If we drop just back up 20%, that's 50% of GDP. That's basically a recession. The bottom line is you drop 20% and stay down. Now, that is almost a guaranteed recession. People just pull back. Everybody knows we're overdue for it. So I don't know how far or how long it's going to be. As people say, I've been wrong forever. Rightly so. Found much better ways to get better performance than the stock market in better returns. Now, I think I look at it as I'll point out facts. We've had two 50% drawdowns in the S&P 500 since the start of the millennium, 2000. I think we're going to set up for another 50% drawdown. That's a bridge way down the river. It starts with one thing right now. If you end this year in the red in the stock market, I think that's the beginning. Been wrong, admit it, but all my indications are pointing that way.
What would change your mind? Let's say the S&P continues to grind higher. At a certain point, you would say to yourself, you know what, time to switch to the more neutral or at least bullish side. What would make you do that? In theory,
I don't know. I don't know what it's going to take right now, but I do point out the alternatives are still shocking. What we saw happen in gold last year, warned us there's something wrong. What we're saying happening in cryptos, warned us there's something wrong. I would love to see some divergent strength in cryptos. Haven't seen anything but that. I'd like to see some of the commodities show anything but just lagging performance versus the stock market, most notably copper. Copper and industrial metals have just been, they're only going up because the stock market goes up. And when the stock market goes down, they go down a lot more. I'd like to see some signs of divergence. And I don't see that. As far as I don't know what it's going to call, but it's hypothetical for now. The call for this year so far has been, so I put out some prudent shorts so far. Beginning year was Bitcoin near 100. I moved that down to 75. People remind me we went through that. Well, right now it's at 62, so it's below that level. Silver around 100. Silver, I think, is only going to go up as the stock market goes up, and it's doing the opposite, around 100. Now that's for drop down. I moved that down to 85. Copper, I put out a prudent short around 6 or above that, so I still haven't do some well on that. Corn above 5 looked like a prudent short because everything's so dependent. And now even crude oil above 100, it to me is a big problem. So I don't know what's going to take, but some of these prudent shorts, so a lot of these things are completely dependent on the stock market going up, are tilting lower. And even despite the stock market going still high, you see that? It's to me, it's an end game.
Well, the fact that oil has been at above $100 and it's still hovering above $90, a recession is still not here yet, at least not in the U.S. In Canada, that's a different story. But a recession still hasn't hit the U.S. yet. What does that tell you? Does that mean the recession isn't coming? I mean, if it's going to come, it should have already happened, right?
We've seen that before. I mean, I've learned my lesson about calling for recessions, and a lot of economists have. The bottom line, the number one, the 10 on a 1 to 10 scale for a recession in this country now is the U.S. stock market going down. Again, it's 2.5 times. It's, to me, that's all that matters. And so if you're at the Fed right now, the best way...
Which makes sense. Now that makes sense how the administration and the Fed are both concerned about propping the stock market up together with more liquidity.
Well, look at the iterations. If inflation stays high like it is, which it probably will, the stock market being elevated, you're going to get hammered in the midterms. It's the number one election. The next president's likely to be a Democrat. It's just the way it works. Yeah. You're missing the main theme here. If stock market goes down, it's recession. What does that mean? It's lose-lose. You're going to get hammered in the midterms. The next president's going to be a Democrat. That's the stage run. They should be panicking. It should be pressuring the Fed to ease, but by pressuring the Fed to ease with stock market cap to GDP at 2, now we're at 3, at 2.5. It's just going to make the plunge worse. Cryptos have figured it out. Gold has figured out. And that's my point, is this is a great opportunity to just be a trader, a great year to be a trader, pick your spots. And the key thing I think that's worthy of buying so far this year is that long bond around 5%, because you get that yield. And maybe now we're finally getting a little dip in their gold of 4,000. That might be initial dip to buy. I haven't really put anything bullish on it yet, but I'll take a look.
Yeah, excellent. Thank you very much, Mike. Excellent show today. Where can we follow you?
On your show, David. I appreciate that. I've enjoyed watching a lot of your other interviews. I'm on the Bloomberg Terminal, on X at Mike McGlone 11, and LinkedIn, Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence.
Appreciate your time, and we'll see you again soon. Do follow Mike in the description down below. Follow his X account, great account, and we'll see you soon, Mike. Take care for now.
Thank you. Cheers.
Thank you for watching. Don't forget to like, subscribe.